Welcome to the Grow Your Business and Grow Your Wealth podcast with Gary Heldt. Gary is an expert in helping business owners put together a plan that will provide a better future for their businesses, themselves, and their families. On the podcast, Gary interviews other professionals who share his vision, and together they share secrets and strategies any business owner can use to build a better financial foundation for your business and your life.
Hey, welcome back to the podcast. This week, my guest is David Kotter, and he is the CEO and president of Hybrid Debt Fund and Integrity Capital LLC, where he provides proactive commercial financing services across the U.S. His companies have funded more than $2 billion to date. Welcome, David.
Thank you for having me, Gary. It's a pleasure to be here.
Great. So give us your background, kind of what did you do before you got into commercial lending?
Well, I'm originally from Utah, so don't hold that against me. And I came down to Arizona in '98, went to ASU. About my junior year, I was trying to figure out, just like a lot of kids, what am I going to do with my life?
Mm-hmm.
And I remember I took a job at Prudential Real Estate Relocation and realized real quick I wasn't going to be an analyst. And so I ended up taking a job buying and selling commercial real estate loans from banks, which how I stumbled into that, anybody knows. And I was able to work underneath a great mentor who taught me how to buy commercial loans from banks across the country. And I cut my teeth doing that for a couple of years and then spun out with a partner back in June of 2003 to start Integrity Capital, where we were advising developers and investors who were building and acquiring and rehabbing projects across the country to provide them with commercial real estate funding. And every single deal is different. I've done everything from the small business owner buying their building for the first time all the way up to national syndicate that's doing, billions of dollars of deals. So it's been the spectrum and been able to do that and have really enjoyed doing that. And then we launched our own fund a couple of years ago, which is called the Hybrid Debt Fund, where we do very niche senior stretch loans that have what's called a participation, kind of 1 to 15 million. So that's what we do.
Gotcha. So what is it about the commercial lending that really, keeps your juices flowing and makes you, excited about, getting up and going to work?
I get bored very easily. I would be probably considered ADHD, definitely was when I was a kid. Had to go to lots of special classes for that. And so I get bored really easy. And this industry can never get bored. It's always a new deal. It's always a different structure. There's always something unique about it, whether it's through the borrowers trying to figure out what they're going to do in their background or whether it's the deal itself. And it's just exciting to me in order to look at a deal and figure out how it's going to work and how's it going to fit within the capital markets. So it's really exciting from my side. I feel like a kid in a candy store trying to put a piece of the puzzle together.
Yeah. What in dealing with the commercial real estate, and then trying to help, the clients with the lending and everything, what are some of the common mistakes that you're seeing that they're making going into this?
Great question. And there's a few things, and I just think that's natural because most people don't know what they don't know. I'd say for the first time person who's going in, they in their mind, if it's an owner occupant, say buying a building for themselves, which I've done before as well, you have this vision in your mind of getting a residential mortgage.
Yeah.
Fill out your 1003, you get your credit pulled, and a few other things, get your bank statements, and you're done. Very different than that. That is obviously a part of it, filling out an application, and your credit is a part of it, but there's so much more that an institution is going to look at. They're going to want to know your experience and do you really have the wherewithal to run and operate this business? They're going to want to know what is the projections on this. I think from a financial perspective, most people have not prepared their financials appropriately to submit to a bank or an institution in a way that is going to make them go, okay, I understand the numbers. So, for example, one of the biggest issues is everybody, and you know this, loves to write everything off.
Yep.
Well, that's great if you want to try to minimize your taxes. The problem is when you go in to get a loan, if you're not showing you're making any money, then the lender's saying, we're not going to give you a loan, or we're not going to give you as great of a loan because we need cash flow. And so really understanding the financials early on and preparing to do that early on is probably one of the biggest mistakes that we have seen in the past.
Right. I guess what's the difference between a bank doing this versus you guys on the commercial
Yeah.
side of it? You know, in I guess what's the difference? But then are there different strategies that you're able to use that the banks can't?
Yeah. Couple things. I would say for owner occupants, those are the business owners buying their own building. Unless you're in this scalable mode where you're buying multiple buildings and you're trying to scale up to it, you're probably going to buy once or maybe twice in your life a building. You're going to get pushed with SBA, right? That's the, 7A, 504. That's pretty normal that you're going to hear that verbiage from the bank, which is just a fancy way of saying we've got a government-backed loan and we want to give that to you. So those are all traditional. They're all pretty much going to do the same thing. Then you have groups who will come in and say, well, we could do this in a life insurance company. So, a life company, you and I go get our premiums from the Protective Lives of the world or the Allstates or these other groups, but nobody really knows that they have a division where they take all those premiums and they lend them. So that is another option for people to potentially use to buy a building. And the difference is you're going to have probably a little bit less red tape. You're going to have probably longer term fixed financing where a bank is going to say, hey, I just want to stay 5-year fixed, maybe 10-year term. They'll go out to 10, 15 sometimes, maybe longer. So you'll get longer term fixed rates when you go that route. The other route is just private. There
Mhm.
are groups out there in the private credit industry, which is really where we play, and they will do the deal with different structures, maybe higher LTVs, or they'll be more creative than a bank. So you're going to have lower red tape, not going to have as many, hoops to jump through. If you've been struggling maybe with the financials, they may focus more on the collateral as opposed to just the business. And so that's the distinction between going to a bank versus going to a private credit institution to get your loan in this particular market.
Now, compared to a bank, do you guys usually, when somebody comes to you to say, hey, I'm looking to purchase or whatever, build, are you guys then helping them prepare their financials? And I don't mean necessarily
Yeah.
to them, but
Yeah, do the
help them
taxes.
get them ready to where they look better.
We focused exclusively on what I call bridge financing or interim financing. So if there's a developer who comes in and says, I buy apartments and I rehab them, or I acquire that industrial building down the street full of a bunch of tenants and it's old and it needs to be renovated. That's what we do specifically, usually 5 to 200 million in size. So the reason people come to us is a couple of reasons. One is access. We have access to a lot of different capital sources that they just don't, which are debt funds, life companies, CMBS, pension funds, family offices. So the accessibility is one of the major reasons people come and use us because they just can't keep up on top of it.
Hmm.
So that's the first reason why somebody would come to us. And then the second reason, and part of what we do is we do underwrite it. We put it in our format. We collect all that information they have and put it in a way that we know that the institutions want to see it,
Mhm.
because they don't want to just get a data dump because they're just busy. They want to get
Right.
something that right at the front of the package, and that first couple of paragraphs, they can get everything they need right there. So they can decide whether they want to do it or whether they don't. And so our part of our job is to decode all of the chaos and put it into a nice format that they'll receive. And that's the second value proposition. The third one is we're not just a order taker.
Right.
We are going to tell them, hey, this isn't going to work this way. And we just had this on a land deal in Colorado we're working on right now, where we came in and said, look, you need to restructure this whole thing. You're not going to get 33 million, probably going to get 20. And here's the phases in which you're going to get it. And here's how you're going to have to structure this in order to make the deal work. So part of that is the consulting to really give them the understanding, the wisdom they need in order to get it over the finish line. That's really the value proposition that we offer. It's bringing the marketplace back to them.
Since COVID, we have seen a lot of buildings and things like that, office buildings particularly, that are under occupied.
Yeah.
How do you guys help people in looking at that from hey, I may want to buy that building. What can we do? Because it's not going to look as good.
Yeah. Well, office, first off, for a while, and I'd say even still so, is kind of a swear word to the lending
Yeah.
community. Office is not, if you ask, 10 lenders, hey, what do you not lend on? You're going to probably hear office for about nine of them. That's going to change, and it is starting to change. But if somebody's trying to buy an office building, first off, they're going to look at it and say, is it in a market that we really feel confident with? Are the feet moving there? Are the employments and jobs moving there? Does it have the demographics that we want to see? That's the first thing they're going to look at. If they get that and check the box, then the next thing is, why will this deal work? Is it just been totally mismanaged and someone just hasn't given the attention and it's an out of state person?
Mhm.
What is the reason? And so there really needs to be a story of, hey, I'm going to come in, I'm going to retrofit this. Quite frankly, maybe they'll condo map it, sell it to owner users. That's a play. Maybe they'll come in and say, we are going to change this and convert it into an apartment, or maybe we're going to convert it to office or flex space.
Mhm.
So some of it depends on what is the market need and can they actually convert it with a reasonable cost basis. That's part of the challenge. A lot of people are like, oh, we're going to convert office to multifamily. Problem is, it's so expensive to try to retrofit the plumbing and all these other issues. So it's really understanding the dynamics of the story and the sponsor, the borrower, who really knows how to execute and make it happen.
Now, if somebody's new getting into real estate now or commercial real estate, what
Yeah.
advice would you have for them?
Have this conversation a lot. And I had a gal call me the other day trying to buy a building first time, and she's a sweetheart. Wanted to get, 100% loan to value. There's just a lot of things that she wanted. And I said, look, I'm going to help you if you listen to me. You can toss my advice if you want to, if you really want to make this happen. And my response to her was, go partner with somebody who's done this a bunch of times. That's the best thing you can do. Go hitch up with somebody, make it worth their while, tell them you'll be the one who raises the equity. That is how you can really go from zero to 50 fast if you want to get something going. That would be the first major advice I would say if somebody wants to make it happen.
Mhm.
The second thing would be, if they don't want to do that, is then start small. Just go buy a small little building, try to figure out something you can get for $1.5 million and use that as your case study to just get something under your belt. And then you have something you can go talk to people about. Those are probably the two pieces of advice I give to people most of the time.
What with where interest rates are and everything right now, um, what are you recommending to people from, I mean, because like you said, there deals you can structure many different ways. I know from the tax side of things, lots of times I have problems with people where they do want to borrow, but they want to show as little income as possible. So we're always fighting that. But then also with interest rates where they are, so many people have looked at, because interest rates were crazy low, and now they are where they are. And I think sometimes people think that where we're at right now is interest rates are really high. you know from the lender side, I mean, obviously you would like them to be higher, but you know where do you see rates and buying power and things like that when it comes to the commercial real estate side?
Well, it's an issue. It started back in 22 when the rates got jacked up pretty fast.
Hmm.
It put everybody into what I call the fog. So people were, when you and I go into the fog, very first thing we do is we get insecure, we slow down, and we don't make decisions, pull off on the side of the road. That's what's been happening for 22, 23, 24, and creeping into towards the end of 25. A lot of deals just didn't pencil because you just run the math and say, well, gosh,
Right.
my interest rate went up kind of 3 times what they were, and now it doesn't work. So the economics just don't work. People that were in the middle of a project, all of a sudden their interest reserve burned off fast because they used to have a 5% rate, now it's 8. So that money they had for a year and a half just cut down to, less than a year. So they ran out of money. A lot of those things are happening right now, and it's been frozen for a couple of years where people just couldn't quite come to the gap between the buyer and the seller because the buyer's going, is the math, and I have to bring in more money, and then it doesn't make sense to me because I have more cash to get a less return. And then the seller's saying, well, I'm not going to dump the price. So that gap is starting to close where all those people were holding on for a long time are now getting forced to sell by their lender who's saying we're not renewing anymore and we want to get paid off. And then the partnerships, the limited partnerships are saying you need to sell this. We understand that we've lost our equity. We understand we're probably not going to get anything back. We just want to be done with it. We're not going to keep feeding it anymore. So those two pressures are finally coming to fruition. We're now seeing people sell stuff for discounts. We're seeing lenders write stuff off at a lower amount. That's where we are in that cycle where it's frozen. Now it's going to start to go down and get reset. And then that's going to create new momentum for this new reset of basis where even those interest rates might not necessarily change dramatically, but now the economics of the deal have come down to where it does work where it didn't before. And I think that's the cycle that we're in, at least this phase now, that we're going to go into 26. You'll see more volume, see more activity, and you'll probably see a little bit more distress. I don't think it's going to be a tsunami, but I think we're there.
It is your tell us a little bit more about your hedge fund.
Yeah, well, I wouldn't call it a hedge fund. It's a debt fund. Just don't want
Yep.
people to think I'm doing a
Yep.
hedge fund because I
Yep.
have
Yep.
no
Yep.
idea how to do a hedge fund. Uh, so it's a debt fund, and it's a very unique thing that was a spinoff of what we saw, which is called the participating mortgage. And what we do is when a developer comes in, the normal thing for them is to buy that industrial building that's old and dilapidated, and they'll go get a 65 or 70% loan to value, and they'll go raise the rest of the money, the, 30 or 35%. And they have their common equity partner and they're off to the races. Bunch of those out there, there's tons of them. We want it to be different and unique and distinct. That's the vision for us. So we said, well, we're going to do the same thing, the first deed of trust. We'll stretch it up past 70. We can go up to 85, even 90. So that means the developer only has to come in with 10 or 15%, maybe 20, depends on the deal. And so they don't have to raise as much money. They may already have 10 or 15% of their own equity in the deal. So that means they get to keep more for themselves. So we'll do that high loan to value, a 3-year term. It's usually 7.5 to 8.5% on the rate. And then what'll happen is we're going to participate with them in the economics. That means we're going to take 35% of the net cash flow and we're going to take 35% of the upside. That's the participation or hybrid component of it. Is you have a debt instrument. We're not actually in their partnership. So we're not in their limited partnership, which is great for the investors because we don't take that risk exposure. We have the deed of trust, so we're their lender. We have the ongoing income that's happening. We just now get that extra bite at the apple at the end where it makes the economics really favorable to the investor. And quite frankly, it's still very favorable to the developer because they don't have to go raise money. They
Right.
get a one-stop shop and they don't have a partner in their LP. And so they get to keep the depreciation. You'll appreciate that for themselves.
Mhm.
And they don't have somebody dictating what they need to do. And that's the distinction of what we offer for this fund virtually, 1 to 15 million in size.
Now, is the public able to get in on your debt fund, or is this just you guys type thing?
Yeah, it's available to accredited investors
Mhm.
who have to meet that criteria.
Yep.
They have the ability to come in, usually $100,000 or greater, to come into the fund. And it's a 5-year fund. It's a closed-end fund, meaning you can't just come in and out. It's a
Right.
5-year hold. And we are targeting 11 to 13% for the returns. So this means they'll get a current 5.5% coupon that's paid out quarterly. And then they get part of that economic component of the upside, which gets them to that kind of targeted 11 to 13%. So what we tell people is you get the benefit of the deed of trust. So if something goes haywire on the deals, we can always foreclose.
Right.
We don't want to, we don't anticipate to, but it's there as a security protection. Then we get the ongoing income, and then we get the upside without taking what we would call private equity exposure.
I think something you just said there, where you can foreclose, but you don't want to. And I
Right.
think many times people don't realize that lenders really don't want to be owning any of the properties. That's
No.
the whole reason why they're lending, and not being the owner. So I think that that's always something that's important. Um, David, we covered a lot of good stuff here. What have I not asked you you wish I had?
Well, I would say that the question maybe around today is, where are the opportunities?
Well,
And
true.
I would say that the opportunities lie in this is a great time to get in the market. There was a period of time where I wouldn't have said that.
Hmm.
But we believe right now is the right time because, if you were coming out of COVID and people were like, okay, what's going to happen? Well, it ended up still going like this, 20, 21, then 22. So we're kind of at this like peak moment and then like 22 happened and it's just like here and now it's coming down. So we think that we've hit that precipice of where we're like towards the trough. And I think the opportunities are, to buy existing facilities that people just overpaid for. And now they're going to have to pick them up and get a reset on their basis. And a lot of them already spent all the money. Like they
Right.
did all the work in the deal. That's what we're excited about is we're going to be able to fund deals where they've already done the work. So you get to just capitalize, unfortunately, on, someone overpaying for an asset.
Right. Wow. If people like what they heard, they want to learn more about your debt fund or more about lending with you guys, how
Yeah.
can they reach out to you? Where can we find you?
You can reach me at dave.kotter, and that's Kotter at hybriddebtfund.com. You can go to the website, which is www.hybriddebtfund.com, is probably the best way to get a hold of me.
Great. David, really appreciate your time today. Enjoyed our conversation.
I did as well. Thank you, Gary.
Great. Hey, this week my guest was David Kotter, who is the CEO and president of Hybrid Debt Fund and Integrity Capital LLC. And I'll see you guys next week.